validated yesterday with the pair returning to break above and now having broken once again below that S1 level at 1.0330. Now, we were maintaining a bearish outlook for the euro. However, following the release of the eurozone's preliminary HICP rates, we saw a strengthening of the euro. So that was roughly on this particular candle, which we're seeing during yesterday's live. We did say that for our bullish outlook to continue, we would have required a clear break above that R1 level at 1.0470. The reasoning was it would have cleared this high as well and would have notioned towards, well, at least towards us, that the pair was beginning to move in a predominantly upwards fashion. Now, having failed to break above that R1 level and now having broken below that S1 level once again, we are maintaining a bearish outlook. The reason is, in my view, that following the ISM non manufacturing PMI figures, which came in higher than expected, in addition to the Jolt Strobe openings figure coming in higher than expected, and then combined with the Atlanta Fed preliminary GDP rate for Q4, the dollar strengthened. And thus, if we look at the dollar against the euro against the dollar, we are seeing a weakening from the euro, USD JPY moving in an upwards fashion, cable moving lower, USD CAD moving higher, despite us being bearish yesterday, having broken that support into resistance level. The Aussie, we're seeing the dollar strengthening once again. Crude oil is moving in upwards fashion. What is interesting would be gold, but one thing at a time. Let's start with the euro. So for the euro, it bounced off that S2, 1.0220, which we mentioned. So that's good. That's our S2, which is now our S1 support level. I could readjust this R1 resistance line, and that's what I'm going to be doing currently. And no, I'm actually selecting the wrong one. Now, we could use 1.0330 as our first support level, but we can bring it right slightly higher at 1.03875. You can see that this is the point where the bullish candle closed and where the bearish candle began. This to me indicates that there is heavy selling pressure at this particular point, regardless of the wicks. The wicks seeked liquidity, and then once they got that liquidity, they moved lower. I'm going to be removing that old R1 level. I will be readjusting R2, taking this peak here, which I'm noting. We're going to be giving an equal distance between our resistance and support levels, as you can see here, which means I would be bringing my R3 resistance line at around here. Validated as support, broke below, and is acting as resistance. And if you look to the left-hand side of our screens around here, you can see that this particular level has acted as support at a prior point in time. Thus, acted as support, turned, and now may act as resistance. So this would be my R3 resistance line. And now we need to readjust these lines. So changing that from green to red, changing R1. That's nice. And then we do need to find a new S3 support level. Didn't act as support, acted as resistance. 3 occasions broke above, acted as support, broke below, pierced, once again acted as support, turned to resistance roughly, broke, support, resistance, support pierced through for liquidity. So this would be my S3 support line. And S3 is actually just below parity, which is very, very interesting. But let's continue. So we have our one resistance line. For R2, we would place at 1.0530. So rounding that down, it's nice. If I remove this downwards moving trend line, then you can see why. And let's just zoom in. So you can see that this was the price action. Euro USD moved in a downward trajectory. It came down. It acted as a support level. So look at where it closed, where it opened, wick down, pierced, so sort of, pierced and moved lower, acted as resistance, pierced through, broke above, acted as support, resistance, support, resistance, resistance, resistance. So that's the most closest reference point for our R2 resistance line. So that would be my R2. and that is at 1.0530. So that would be my R2. We've explained why we would have R3 at this point. You can see that this acted as a support level. Once it broke below, it may act as a resistance line, but that remains to be seen, and we would like to see that being tested. So that's R1, that is R2. I do need to readjust this line 1.0385, and that would be R1. We are going to be moving on to cable in just a moment, so we just need to finish prepping this chart. So 1.0675, that would be R3. Very nice. So you can see our support and resistance levels, whether we're readjusting or placing them together, are valid. So if you were joining us yesterday, you would have seen that we had placed this as two line. That was validated. So that's a valid support level. And this now becomes S1 at 1.0220. I am very concerned that the euro may be nearing parity and moving towards it. Now, that being said, it is very easy for someone to claim and state that we may be moving to parity. There are a couple of issues that we should take into account. The JOLTS figure was for November. The ADP figure for today, if I'm not mistaken, is for December, and then we have the US employment data on Friday. I could easily say that we're moving towards parity, but the reality is, if the NFP figure comes in lower than expected, so less than that 160K, which is roughly being touted by economists, then we could actually see the euro gaining against the dollar. Moreover, we have the unemployment rate, which is expected to remain steady at 4.2%. So even though we are maintaining this bearish outlook, one is it has failed to break above that old R1 level. Now we've readjusted. It's found resistance, appears to be moving in downwards fashion. It was also at the mid range of the Bollinger Bands. And then we have the RSI, which is reading a figure of 38, which implies a bearish market sentiment. So, personally, from a technical point of view, we would be bearish. That being said, the story could easily change on Friday. Earlier than Friday, we have ADP today, and then we have the Fed's minutes. So, the Fed's December meeting minutes, which are set to be released, if I'm not mistaken, at 9 p.m. GMT plus 2. So we are going to be discussing those minutes. The Fed, in their last meeting, knew the outcome of the US election compared to the meeting prior to that. So they knew that Trump is going to be president. He is going to be inaugurated on the 20th of January. We saw a hawkish sentiment emerging from the Fed. Regardless of political beliefs and views, there are some that say that Trump's economic policies could lead to an increase of inflationary pressures in the US. And thus, we are seeing a bit of a pivot from the Fed in preparation to that potential and to that possibility. If it does bring inflationary pressures, and that is a big if, because he is not president yet, and we do need to see as to whether or not he will go through with his campaign promises. However, if I was the Fed, I would be preemptively preparing for such a scenario. So I would not be surprised if the Fed's minutes today are perceived as predominantly hawkish in nature. For example, implying that the Fed may take a more gradual rate cutting approach, which is the expectation of two rate cuts this year, and that might be intensified. If you look at the not the ADP, if you look at the JOLTS, the ISM non manufacturing PMI figure, the preliminary GDP rate for Q4 from the Atlanta Fed, it does give the Fed some leeway should they wish to be more cautious on the rate cutting approach. So, but that was released today. We're looking at December. Still will not be surprised to see the Fed being slightly more hawkish in those minutes, which in turn could aid the dollar. Now, if the dollar moves lower today following the Fed's minutes, it could reach and break below S1. That would be a requirement for us to continue that bearish outlook. The next target could be at S2 at 1.0095, which is very close to parity. If we combine that with a resilient labor market on Friday, based on the NFP and the unemployment rate, should they come in better than expected, show a lower unemployment rate than 4.2 and a higher NFP figure than 160K, then we could actually reach parity by the end of the week. It is a possibility. Now, that narrative can easily change. But since we're looking at this from a technical point of view, it does appear to be moving in a downwards fashion. So we would maintain a bearish outlook for the particular pair. And RS3 is actually just below parity at 0.9970. This might be an issue for the Eurozone because a weaker euro makes it more difficult to do business with the US. Honestly, the way the ECB may react to parity, maybe they may wish to take a more hawkish stance, but realistically speaking, Germany's economy is in trouble. HICP rates came in hotter than expected, but still, looking at it from an economic perspective, the ECB may need to remain dovish. But that's a discussion for another time. For now, we have placed our support and resistance levels and are maintaining a bearish outlook for the particular pair. We're going to be moving on to cable. Actually, no, USD JPY. So, USD JPY, yesterday we had placed our resistance level, which we actually more or less kept the same, 158.35. Now, we're discussing that I hadn't placed the resistance level here because I was looking towards the left hand side of your screens and opted for this particular resistance line. You can see that yesterday this was validated. Note the wick, which is touching on R1 at 158.3, retraced lower, but is still moving in an upwards fashion. This makes sense as we've discussed that the dollar has been strengthening over the past day. If you look at the RSI indicator as well, it currently registers a figure of 66, implying a bullish market sentiment. So we would maintain a bullish outlook for the pair as long as it breaks above R1. If it fails to do so today as well, then that might be an issue. It could maintain in a predominantly sideways fashion. And we're now dropping down to the 4 hour time frame. Note a first touch, a second touch as well. It is meeting heavy resistance. From a 4 hour, it is close to 60, but is currently below. Would not be surprised to see the pair potentially seeking some liquidity or breaking and strongly breaking this R1 resistance line. But that remains to be seen. But it has been validated again that 158.35 is a valid resistance line. For support, I'm going to keep it at 155.35 just to give it some room in the event that we are seeing a strengthening on behalf of the JPY or a potential intervention should the BOJ intervene, although that does not appear to be in play currently. Moving on to cable. Once again, if you're with us yesterday during that live technical analysis session, we had support at 1.2515. Note how it acted as a resistance level today. Acted as resistance. It may have wicked above, but just monitor. Look how it closed. There's resistance. So this is indeed the resistance level. That is very nice. So this becomes R1 and then so on and so on and so on. Would maintain a bearish outlook for cable as well, due to the fact that we've discussed that the dollar may strengthen today and, well, basically today and was strengthening yesterday as well. So that's R1. This would be my R2 at 1.2675, R3 at 1.28450. In terms of financial releases, we had the Halifax house prices, but in all honesty, I think the pound is ceding control over its direction to the dollar. Have a high number of financial releases, high impact as well. Monetary on a monetary level, we have the Fed's minutes, so it would make sense that the dollar would dictate the pair's direction. And let's remove this because this is useless currently. For support, we could either keep S1 at 1.2295. That would still be a valid support level, as seen by this wick here. But if you want to play it on the safe side, we could add and bring that support level slightly higher at 1.2375. So take into account the most recent price action. So this could be indeed our support level at S1. For our bearish outlook to continue, as usual, we would require a break below this S1 level. For S2, we've readjusted that old S2 slightly higher, which means we can't really use that old support level and would require a bit of a distance for it to move. Otherwise, what's the point of me placing S2 here? Could easily be broken and then it wouldn't be a significant support level. And then that would be simply useless, for lack of a better word. So I'm placing, and I will explain why. I'm placing S2. You can see high, higher low, strong buying pressure. As you can see how it continued and cleared this old resistance line, which is now our S1 support level. So as you can see, at a prior point in time, this has also served as a support level. So further validating S1, which is a very good thing. And then we'll place S2 around here. This acted as a resistance support, pierced for liquidity, but acted as support. That's very nice. And then you can see here, took out everyone that had their stop loss here, moved higher. So heavy buying pressure at 1.20665. So that would be my S3 my S3 support line. I don't know why S1 says 0.997. Okay. Let's readjust. Nice. This is S1. S2 at 1.220. At 1.220. Now, because we are readjusting this, we should make sure that this actually still coincides with what we said before. It does, so that's a good thing. Otherwise, we would have to readjust it once again. And then for S3, 1.2065. That would be my S3 support line. So we have our support and resistance levels. The RSI is just below 40, implying a bearish market sentiment, so we would maintain a bearish outlook for the pair. USD CAD. Now, yesterday we said that we were going to be maintaining a bearish outlook for the dollar against the Canadian dollar, but that was before the release of the financial releases I mentioned before, so ISM, Atlanta Fed, etc., etc. You can see that the dollar has strengthened and has broken above that old support, turned to resistance, now turned to support. Why is it support? If you haven't noticed, look at this candle's wick. Reached for support. Let's drop down to the 4-hour time frame. Should be clearer. Voila. It broke below and acted a bit as a resistance line, but once it broke back above, support, roughly support. So 1.4340 acting as a very nice support level. And so that becomes S1, and then the issues continue because we do need to find R3, and then S2 is fairly far away. We can bring S2 to the point upon which this bullish candle closed and acted as a support line based on the opening of this bullish candle, wick down, validating this as a support level. So we can readjust S2 and bring that slightly higher at 1.4220. So this can be used as that S2 support line, and then we can keep that old S3. Now, the question remains is what do we do for R3? Well, one option would be to measure the distance between S2 and S3 and then reflect that upwards from R2, which is what I'm going to be doing. I have made a bit of a mistake here. Okay. Nice. 1.4335. Control A, Control C, and make that as S1. We can fix the text labels later. 1.4220. So that would be S2. For S3, 1.04088, or if we put it 1.0490. Very nice. Then we have R1, double top, 1.4465. That would be R1. And then if we use this tool on MT4, the crosshair, you can left click and drag. So 117 pips. So let's say 120. That would be at 1.4590, 1.4590. Now, this is a rudimentary resistance line. For it to be valid, I would like it to be tested. It is a hypothetical resistance line, and that should be noted and emphasized on as well. And then it's 130 pips. So 130 would be at around 1.4720. 1.4720. Nice. And then we have our resistance levels, well, hypothetical resistance levels. 1.4590, 1.4465, 465, that is R1. This is S1, S2, and S3. So we've done the support and resistance levels. Now we said for the euro cable that we're bearish, and then for the US dollar against the JPY that we are bullish. For the CAD, that doesn't seem to be the case currently, despite the RSI being very close to 60, which does imply bullish market sentiment. I wouldn't be exactly bullish. The reason is Canada is an oil exporting nation. And if you look at crude oil's price, is moving in an upwards fashion. So in theory, if oil prices are moving higher and Canada is exporting oil, demand for the Canadian dollar increases as well, which could provide it some strength. So given that we're saying that we're bullish for oil prices, as we said yesterday, I wouldn't be exactly bullish for USD CAD, for the loonie. I'd opt for a sideways bias, so I would like to see the pair moving to test for a third time in a row 1.4465 and failing to break above, and then staying between S1 and R1 for a sideways bias. Now, in the event that I am wrong, which is possible, I would require a clear break above R1. The next target could be at R2 at 1.4590. Other than that, we have 1.4720. So these are the support and resistance lines. For a bearish outlook, a break below S1, if not S2 as well, just to be certain that it is moving in a downwards fashion. But of course, one can never be certain. For the Aussie, we're seeing the dollar strengthen. The meeting earlier on today feels to have been relatively insignificant. The downwards moving trend line continues to be valid. So we are maintaining a bearish outlook for the Aussie. It didn't exactly act as a resistance, though the trend line close to it on the Bollinger Bands, RSI is at 34. Target could be at 0.6160. Lower than that, we could have it at 0.6055 based on the RSI and the downwards moving trend line as well. Crude oil, we did say, and we are maintaining our view that we are bullish for WTI cash, having broken upon above this sideways moving channel, which we said yesterday as well, at 72.10, which acted as a resistance line. The next potential target for bulls could be at 77.85. Now, if the current situation in the US worsens in terms of, I'm not mistaken, there are wildfires, there are some issues in terms of uh, quite hard. Uh, the It appears that there are some issues, wildfires, etc. Now, if that influences oil production and then there are concerns about supply, then we could see a boost for crude oil prices. But because I haven't really read that much into it, I won't discuss it further. Nonetheless, technical point of view, RSI is just shy of 70. Strong bullish market sentiment. Some accumulation of buy orders. Target could be R1. Higher than that, we could have R2 at 83.85. Please note that we have been showing daily charts. So that is something that one should always look out for. It's not a 4 hour, it's not a 15-minute time frame, it is a daily chart. So within a daily chart, as most of you all know, that's one direction. 4 hour, 15-minute can all show a very different story. But we can judge and see the predominant market direction, so the primary trend, which does appear to be upwards in nature. Although I did say yesterday I would have liked crude oil to test S1 and then move higher. Nonetheless, we have R1, R2, and R3. You can see that to the right hand side of your screen, 77.85, 83.85, 89.45 for support, 72.10, S2 66.45, S3 61.45, and I would ignore S4 at this point in time as it is not in play. Still, we still have it. Oil, oil, gold. We've placed our support and resistance lines. We edited those yesterday and they still appear to be valid. Tested R1, 2665, validating this as a resistance. There is an upwards moving trend line, but the RSI is still at 53. Now, it is surprising that despite the dollar strengthening against its counterparts, the precious metals price is still moving in an upwards fashion. Could it be geopolitical risks? Possibly. Persistent inflationary pressures? Mm, maybe a possibility. Still, it does appear to be moving slightly in an upwards fashion. I would maintain a sideways bias as long as it doesn't clear R1 at 2665. If it breaks above 2665, which is my R1 line, I would immediately switch for a bullish outlook with the next potential target being at R2 at 2725. If it rejects R1 and fails to break above R1, then I would opt for a sideways bias and continue with that outlook, staying between S1 and R1. And then this can also be used, and we will look at it tomorrow as well, based on the Fed's minutes today. Intel appears to be moving in a sideways fashion. Note S1 and R1 staying between that range, 18.90, 22.10. We could readjust our R1, but it's Intel. So let's just keep it there for now. Narrowing Bollinger Bands further tends to imply a sideways bias. Microsoft, as we did say yesterday, could have been a high, moved lower. Ooh, Nvidia. Note how that R2 level at 152.65 held up. That is quite interesting. Looks like the announcement was well received initially, but is since moving lower. This could also be in effect due to the concerns about a potential trade war with China, and Trump's gold as well may have been influenced by the president-elect's comments about Greenland and not ruling out the potential use of force to seize the Panama Canal. So geopolitical risks could be aiding the precious metals price, which makes sense despite the strengthening of the US dollar. For Nvidia, my support level is 138.70, S2 at 131.20, and then S3 at 124.75. That is something that is a bit interesting as well. ExxonMobil. So we've kept these support and resistance levels for quite a long while. Note how this old support level broke below, moved lower, broke above, acted as support, still valid. Target could be oldest one at 111.75 dollars per share, be the target. R3 is still at 43, which does imply bearish market tendencies. But if we look at it, we might be seeing a bit of a recovery from ExxonMobil, although we do have a death cross. So that is a bit interesting. Oh, time will tell. Wouldn't be exactly bullish for ExxonMobil, but still not bad. FTSE. I think I haven't changed this chart for the last 2 or 3 months because there is literally no need to. It is moving in a predominantly sideways fashion. It was looking as if it may have been moving in an upwards fashion with this upward swing trend line. Found resistance 8,330, broke below, so I'm maintaining that sideways bias. RSI is at 50, currently 47, but very close to 50. So sideways bias for the FTSE, and we've been maintaining this sideways bias since let's say since literally last year. So yeah, not bullish, neither bearish for the FTSE 100. Tesla might be moving lower. High, lower high being formed, gap filled, mid range with bunch bands. Bearish for Tesla stock price. It's a bit of an issue, the comments Elon is making. He's getting involved in the politics of Germany and the UK, and that's a bit of an issue. We also should note that in the event of a trade war with China, Tesla might be influenced due to their reliance on lithium and core materials stemming from China, which could increase their cost of production. And then, if you increase cost of production, then you may have to raise prices for your cars. If you raise prices for your cars, then you might sell less because if you look at BYD and NIO, even if you throw in 100% tariff on them, they're still cheaper than a Tesla. So if I was going to be buying an EV and I was not a Tesla quote unquote fanboy and really wanted just an EV, I could purchase a BYD or an NIO model, which even with the tariffs would be cheaper than a Tesla. So that is something that we should keep an eye out for. Wouldn't be very bullish on Tesla stock price. Instead, I would maintain a bearish outlook. RSI dips below 50. Technicals may be supporting a retracement, so we'll keep an eye out on Tesla stock price as well. McDonald's staying between that old S1 and S2 level. Uh, Japanese stock market's looking nice, would be bullish. RSI closing on 60. The bullish market sentiment pierced through. Would require it to clear this 40,149 figure. Still not bad. IBM, no, not even a support and resistance line here. LVMH remaining in this sideways bias. Too much of an exposure in China for your sales. That's bad. Lockheed oversold at this point in time. It's 20. RSI below 30 and strongly below 30 may imply that the company stock price is oversold. Maybe due a correction soon, but overall a bearish outlook for Lockheed Martin. Volkswagen finally recovering slightly, breaking above oldest 2, 89.50. Not bad for Airbus. Rolls Royce we would ignore. Google might fill this gap here. Deutsche Bank, bullish for Deutsche Bank. JP Morgan and Chase. I would withhold any judgment for that stock price currently. Dow Jones daily chart support acted as a resistance. This could be changed. So using these 2 wicks, found heavy support at that point in time. But based on the movements, we would have to take a more cautious support level. So as to maybe 2000. It's not looking that good actually. Bearish for the Nasdaq as well. Look, high, lower low, lower high, lower low, lower high. This for me would be bearish. And we could see resistance around here. 21,350. Maybe a retracement and then moving lower. Would be bearish for Nasdaq as well. S&P 500 bouncing off S1. Lower high, maybe. It's not looking that good for the US stock markets. Good for Boeing. 172.14, more than I would have given them. So that's good for them. Eurostox 50, ooh, very, very nice. Eurostox 50 moving in an upwards fashion, having broken all resistance levels. Slightly bullish for the Eurostox 50, actually. 65 on the RSI, bullish market sentiment, clearing R1, R2, R3. Would like to see it clearing this high, then retracing. Actually, quite nice. Good for the Eurostox. And with that, that probably does it for today. Thanks for tuning in. I will see all of you tomorrow, same time, same place. We will dissect the FOMC's meeting minutes, which are due to be released tonight. We'll also discuss the release of the ADP figure, see what Thursday has in store for us. So that would be interesting. And we'll make a bit of a prep for the NFP figure on Friday, which means we will be placing support and resistance levels fairly wide from one another, just in preparation for the three possible scenarios, which is stronger greenback, relatively unchanged greenback, and a weaker dollar. So we will be preparing tomorrow for those scenarios, and we'll be discussing what has happened later on today. As always, thank you for tuning in, and I'll see you all tomorrow.
But we are back, and today's session we are going to be talking about market liquidity, understanding depth and volume. We will have some time at the end of my slides to look at a couple of charts. So if you guys have any requests for any charts you'd like me to go through, feel free to just pop them into the chat, and I'll be happy to go through them after I'm done with my slides. Okay, I think without further ado, we can go ahead and get started. But stop me anytime if you can't hear me or you can't see my slides. Yeah. So, okay, let's get started. So, as per usual, before we start, a disclaimer and risk warning. This information is not considered investment advice or investment recommendation, but instead a marketing communication and a risk warning. Our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. Okay, so I'm Melanie and I'll be your speaker for today. I'm an investment analyst at Rocket, who were finalist for Best FX and Equity Research in the years 2019 to 2021. So here's our agenda for today. We'll look at market depth and volume, liquidity providers, impacts of liquidity on trading, and so on and so forth. Okay, let's start. We'll start off by going through a bit on understanding market depth and volume in forex trading. So, in the forex market, market depth generally refers to the measure of supply and demand at different price levels within the order book. So think of it as the amount of buying and selling interest in a currency pair across a range of prices. So when we talk about a market with depth, we're referring to a market with lots of orders at various levels, creating a deeper order book. So why is this important? Because in a deeper market, which means one with a large number of orders on both the buy and sell sides, traders can execute larger trades with minimal price impact. So this means that the price won't move much even when significant trades occur because there's enough liquidity to absorb them. So to visually kind of demonstrate this concept, you can imagine a situation where a large buy order enters your market. So in a market with high depth, this order will be filled by the multiple existing sell orders without significantly impacting the price. But if it's in a low depth market, a single large order may cause a substantial price shift because there isn't enough opposing orders to absorb it. Okay, so when it comes to market depth, there is this market depth chart that I have included here. And it's basically a graphical representation of the order book, showing us the price trends and the patterns that change as pending orders and liquidity fluctuate. So the chart shows your demand and supply levels. That's your X and Y axis. So the X axis represents the market prices, while the Y axis represents the amount of pending orders. So the chart basically enables the trader to understand the price changes and fluctuations in the demand and supply patterns. So through this, you as a trader can evaluate the efficiency of investing in the given security. So you can see the chart is split between two sides, left and right. So it represents the demand and supply of different price levels. So in the best scenario, both sides of the chart will be balanced or almost symmetrical. And any uneven tendencies will be depicted as the graph skews to either side, which represents either market shortage or excessive liquidity. Okay, so here, if you look at the left side of the vertical axis, Okay, so the left side of the vertical axis is your buy wall. So the buy wall represents the cumulative value of buy orders placed on the given security at your different price levels. Okay, your buy wall is this side, the green side. And then your sell wall, which is the right side of the vertical axis, represents the cumulative value of the sell order that's placed on whatever asset you are trading at different prices. The vertical y-axis that represents your price level, and your x-axis represents the volume of the pending buy and sell orders that have been placed. So the mid-market price, which is just the middle line going down, between the buying and selling, or it's just the middle point between the buying and selling, or basically your average between the highest bidding price and the lowest asking price. So here you can see, in the case of Bitcoin, the mid-market price, which is the average, would just be 100,000. Okay, so this chart, it works as an indicator, and it works by hovering over the chart, which reflects the number of assets that can be bought or sold at a given price point at a specific time. So it also shows you the cost of executing the market order and the implications on the market value. And TradingView actually has a depth of market chart as well. So I'll show you guys in a little bit how you can use that. Okay. So what's the importance of this chart? It's basically used to predict current and potential market directions, and also discover support and resistance levels, which assist investors in creating their trading strategies. So if the depth chart is tilted to the left, it means that the asset is illiquid and the price will potentially increase because demand is higher than the supply. On the other hand, if the chart is tilted to the right, it means the asset is sufficiently liquid and prices are more likely to stabilize or decline because supply is more than demand. So you can use this information to place suitable market orders. So for example, if the market is skewed to the left, means that there are more buying orders than selling. So there's lack of liquidity. So your product or your security is becoming illiquid and is more likely to increase. So in that situation, you would then place a buy order so that you capitalize on the likelihood of a price surge before selling at a higher price, so that you can reap your gains. Okay, any questions so far? Okay, I'm gonna show you guys the TradingView website, um, which basically shows us how exactly you can use it. You can watch the YouTube video as well, but I'll just briefly go through how you can use it on TradingView since we're talking about it now. So you can click on the trade button in the trading panel over here. Okay, this isn't very important. Yeah. So these are the key elements. I'm just gonna go through them over here. Let me see. Can you guys see my screen? Is it too small? Okay, great. So, oh, you can't see my screen? Okay, I should be sharing screen now. Okay. Um, yeah, I can zoom in if that helps. So the first bubble is our place orders. Second are your ask and bids. It's number two. Number three would be your bids, so the volume of orders that's available in the market that we just talked about earlier. Number four, okay, let me zoom in. Point four, or the bubble number four, basically are the cells for placing your orders. So when you click on it, a limit order is placed in them, and then when clicked while holding your control button, your stop order is placed. Okay, number five, uh, which is these X's, it's just to cancel or limit or stop orders based on whatever security you are trading. Number six is your centering button. Number seven, the size of number seven is here. So that's just the size of all of your open positions. Number eight is the profit and loss of all of your open positions. And you can also change your display setting. So if you click on it, you can change the element to money, pips, or percentage. And number nine is your closing position. 10, obviously reversal. 11 would just be the button for you to cancel all of your orders on your current security. And number 12 is the quantity field. Um, you can see here units that basically shows how many units of your security you're purchasing or sold when you're placing an order. Okay, so how it works basically is it uses um, data from the broker, from the specific broker. So data is displayed in static mode, which means that the price series is fixed. So while price moves between these values, it's normally either above or below the designated range. Okay, so I will speed ahead and show you guys how you can place an order. Yeah, so to place a market order, you just basically click on that buy market button from above. And then you can go ahead and indicate the number of units you want to purchase or sell. And then similarly for limit as well, you just click on the cell next to the desired price. Um, I think this is pretty straightforward, so I'm just going really quickly so we can move on and look at our have more time to look at more charts. And then for a stop order, you can hold down the control key and click on the cell that you want to place your stop order in. That's in the left column and buy and right column to sell. Yeah, and then you get a confirmation and you can change your orders as well. Okay, so yeah, I'll just get back to my slides. Are there any questions so far? Okay, we have a question. How how does it work? Okay, so like for example, let's take a random asset, right? And maybe it's currently priced at $1. The DAOM will show how many orders there are for prices of 90 cents or maybe $1.10 and so on. So in doing so, it will show you the supply and demand for that asset without having to switch tabs or to manually track. How did you display it as chart? Okay, let me open my trading view and we can go through this. Okay, let's go back here. Okay. What do you mean by how do you display it as a chart? The market depth. So in order for this to work, you actually have to connect your TradingView account to your brokerage account first. Which graphic? This is just on the TradingView website. I'll just pop the link into the chat. Okay. Let's go ahead and continue. So next, we'll just quickly look at the role of trading volumes now. So when it comes to volume, it's basically simply put the total amount of an asset. So it can be like your currency pair or whichever security like traded over a specific period. So it's a powerful indicator of the market's interest in a given asset and can signal potential future price movements. So high volume often reflects strong market interest. So um, for example, when trading volume is high, it can indicate that many traders are engaged or possibly, confirming the strength of your trend. So in the case of a low volume, it might show lack of interest or uncertainty, which can make price movements less predictable. Okay, so we take a closer look at the difference between high and low trading periods and how they might influence price directions. Here it says, for instance, high trading volume often accompanies strong trends, meaning that if the price is moving upward or um, downward, a high volume can confirm that movement. So on the other hand, low volume periods can lead to erratic, unpredictable price movements because there are fewer active traders to support a clear trend. So to visualize this, you can imagine a currency pair that's experiencing a strong uptrend with high trading volume. So this high volume basically supports the trend and adds stability to the upward movement. So it makes it less likely to reverse suddenly. However, in a market with low volume, say um during a holiday maybe, price movements may be much more volatile since there's fewer active traders. So there might be quite rapid and unexpected changes because of that. Okay. So if there's more sell orders than buy orders, prices likely to drop. Yeah. So when there are more sell orders than buy orders in the market, there's kind of that imbalance, and that typically will drive price down. So that happens because there's more supply um, of sellers wanting to sell than demand, which is basically buyers wanting to buy at your current price. Okay, I hope that answers your question. Okay, great. Okay, let's now look at the relationship between depth, volume, and price movement. So if we bring all of both, basically all of that together, In general, high volume and deep markets will tend to have less price volatility. So that's kind of the relationship between that. So high volume and deeper markets have less price volatility. Reason being that these are stable conditions where you're likely to see smoother price action with fewer sudden spikes or drops. So high volume and high depth provide a kind of buffer, absorbing large trades and reducing the likelihood of erratic price changes. On the other hand, low volume or low market depth can create the opposite effect. So in these conditions, price volatility increases, meaning you're more likely to see sharp price spikes or sudden drops. For example, in a low depth market, even a modest buy or sell order might shift prices significantly because there aren't enough opposing orders in the book to counterbalance it. So we can look at this by thinking about two scenarios. So during quiet times, such as weekends or holidays, the market typically has lower depth and volume. So this creates a volatile environment where even small trades can lead to large price swings. So in contrast, if we think about an active times, so like during a major economic announcement or central bank decision, that will bring higher volume and more market depth. So this depth and volume can provide greater price stability and reduce the impact of your individual trades. Okay, so that's why we often will recommend that you look at your fundamental analysis so that you are kind of aware or you can anticipate these periods of active periods compared to quiet times as well. Okay, so now that brings us to looking at some of the main factors that influence liquidity in the Forex market specifically. So liquidity, as we know, can vary significantly throughout the day and in response to certain events. So understanding these variations can help us to make better trading decisions. The first thing is time of day. So liquidity, we mentioned, changes throughout the day based on trading sessions. So the Forex market operates 24 hours a day, but liquidity is not consistent. So it fluctuates depending on which major trading sessions are open. The main sessions are Tokyo, London, and New York. So typically during the London-New York overlap, which happens around 1 to 5 p.m. GMT, we typically will see the highest liquidity. So this overlap period brings together two of the most or the largest financial centers in the world, which creates more trading activity and tighter spreads and smoother price movements. On the other hand, low liquidity will tend to be during the Asian session and on the weekends. So that's when fewer traders are active. So low liquidity in these events or in these periods can lead to more erratic price movements. So it's generally advisable to be cautious when trading outside of peak hours. Number two would be economic events and news volatility. So these events are pretty significant factors that influence liquidity. So liquidity tends to be high during or on the lead up to scheduled announcements, since traders will tend to take positions based on the anticipated outcomes. So examples of major economic news events would include Federal Reserve meetings, non-farm payrolls, um, unemployment reports, so on and so forth, and also interest rate announcements. So interestingly, while liquidity is high before these announcements, it can drop sharply immediately after, especially if the news was unexpected or significantly impacts market sentiment. So this post-announcement period can lead to increased volatility, making it really essential for you to be prepared for any sudden price movements. Okay, number three, geopolitical events and policies. So this is also another major factor influencing liquidity. This can be like your elections, wars, and policy shifts. Such events will introduce uncertainty, and when the outcome is unclear, traders will often hesitate to open new positions. So, for example, in times of political tension or economic sanctions, liquidity can dry up because there's a lot of uncertainty about how these events will impact the markets. So that's why we see lower liquidity and increased volatility during your global crises. So events like Brexit or the Russian-Ukraine conflict or even the recent elections can lead to low liquidity conditions um, while traders try to assess their strategies amid the instability. And lastly will be central bank interventions. So this is pretty straightforward, so I'm just going to verbally explain it. Um, Central bank interventions will include things like your Federal Reserve, your ECB, the European Central Bank, or Bank of Japan. So those are kind of the main central banks that will impact liquidity and currency values through their policy decisions. So if they adjust interest rates or they intervene in the FX markets, and they can also use open market operations to either inject or withdraw liquidity from the market. So that's how they influence liquidity. So, I guess just as an example, when a central bank announces a significant policy change, like an interest rate hike, it can increase liquidity as traders adjust their portfolios. So similarly, open market operations where a central bank buys or sells large volumes of currency can have a major impact on liquidity levels. And in turn, that will also affect currency prices. Okay, any questions so far? No? Okay, great. That actually brings us to the end of my slides. Um, so let's go ahead and take a look at some charts now. Okay, I think we'll start off by looking at EXY. Yeah, we'll take a look at gold after this, since gold is inversely correlated to the XY, so we can see how that might affect um the prices. Okay, so on our weekly time frame, you can see the price of DXY is shooting upwards. Let me just connect my mouse. Okay, so on our daily time frame, you can kind of see prices testing this resistance level here. Um, Even though the overall trend is still pretty bullish. Okay, this is gonna be my second resistance. Okay, and for my first support, I'll just place it maybe here. Okay, so this is just purely based off of graphical analysis. So I'm just looking at where the swing highs and the swing lows line up and trying to identify all of the significant levels. Okay, now I'm going in with our Fibonacci levels. I'm starting off with a retracement, and you can see my 50% lines up. Okay, I'm trying to see if we have any projections here. Our 61 kind of lines up and 78 as well. So just keep those two. Okay, I have another projection here. I think. Okay, so my 100% also lines up with my first resistance. Even though the 61.8 does line up nicely with our first support, we can't use it anymore because price has already broken out of that level. So we'll just use the 100. And for our retracement, okay, my 38.2 lines up with my first support. Okay, I think this is our confluence area because we have about two, yeah, we have two Fibonacci levels that line up nicely. So if you're not familiar with confluence levels, um, they're basically when two or more Fibonacci levels line up in that same area. And what's significant about it is that prices tend to be attracted to these areas, but might not be able to push past them. Okay, so that's why we want to try and identify these levels. Like you can see here, it's a confluence area, and you can see price has also tested this level multiple times in the past with 1 and 2, 3 swing highs. So now you can see price is facing a bit of resistance here. Okay. Now let's take a look at some indicators to see what they're telling us. So I like to use Ichimoku and MACD because at one glance you can tell exactly what the signals are. So with MACD, it's giving us a bullish signal. Ichimoku is also giving us a bullish signal. Let's look at Bollinger Bands. Okay, it's also pushing above the upper band of the Bollinger Band, so that's also giving us a bullish signal. And we normally will recommend you to follow the general trend, which we can see here is pretty bullish. But we just want to highlight this level just in case, just so that you are aware of any potential reversals of this level. So as of right now, it is pretty bullish. I'm just gonna just have to be careful about this confluence area here. Okay, let's maybe look at some momentum indicators. RSI, stochastic. Okay, so we have prices moving in an ascending trend line on our RSI. Let's take a look and see if, okay, on our stochastic as well. So there, all of the indicators that we've used so far support our bullish analysis. Okay, and yeah, this is on our daily time frame. Okay. Um, any questions before we move on to gold? No? Okay, let's move on to gold now. Okay. So, like I mentioned earlier, gold and DXY tend to be inversely correlated, because they're both seen as safe haven assets. Um, but in the event of, geopolitical events, there are occasions where they do move in the same direction. As of right now, you can kind of see prices of our DXY going up, and while our gold is dropping quite significantly. Okay, so on our weekly time frame, prices are moving downwards, daily as well. Maybe let's look at our 4 hours. Okay, we can see prices moving in a downtrend as well. So going ahead with our horizontal levels, this will be our first resistance, second resistance, or maybe further down here. Okay, because it's in line with two swing lows. And then for my first support, I'll place it mm, okay, maybe down here. Since it's an overlap level, it's in line with multiple swing highs and swing lows. Okay, so going in again with our Fibonacci levels, you can see my 38 and 61 both line up. Mm, okay, no. I think my 23 lines up. Yeah. So my 23.6 lines up with my second resistance. Um, we might have an inverted Nike tip here as well. Yep, so my 161 also lines up. Okay, it lines up with my first resistance. For reference, this is the Nike tick I'm talking about. It's inverted, so if it's upright, it'll look like that. Now it's kind of upside down, like that. Okay, so this area is also a confluence area. So you can see price kind of testing that level as well. Oops, okay, I labeled it wrongly. This should be our first support. And then this should be our second support. Okay, because I'm expecting price to continue to drop. Okay, again, this is just kind of like a warning because it's in line with a swing high and swing low, and also with multiple Fibonacci levels. Okay, so let's pull out some indicators again. So price is moving below the cloud, so it's giving us a bearish signal. MACD is also giving us a bearish signal, so they both support our analysis. Bollinger Bands, price you can see pushing below our bottom band, so that's also supporting our analysis. Okay, there isn't really a descending trend line here, so I'm going to remove that. But you can kind of see prices moving into the oversold regions. Um, here as well on our stochastic. Okay, but I'm not gonna use that for now. Let's maybe look at our parabolic SAR. Okay, we have prices moving below the indicator, so that's also a bearish signal. Okay, if you want to be a little bit more careful, you can add mm, yeah, I was gonna add this kind of like an intermediate level here instead, in line with the 50%. Because that's where I wanted to place it originally, since it's in line with a whole bunch of swing highs in this area. So it is quite a significant level. Also because it's in line with a 50% retracement. So we have a couple of things supporting this level. 50, 61, and 32, 38. Okay, any questions? Okay, if not, since we briefly talked about looking at an economic calendar to keep up with, all of the announcements, um, I just really quickly want to show you guys Forex Factory. This is just an option that you can look at to keep up with your fundamentals. So you can look at the events for the week or for the month, whichever you prefer. And you can see I have it to only focus on the orange and red, and that's medium to high impact events. There's also low impact, which is the yellow, and non-economic, which is the gray. And that includes any like bank holidays, which, as we have seen during our slides, those are low liquidity periods. So it's quite important to know those as well. Okay, so like this week we had the French bank holiday, Canadian bank holiday, so you would try not to trade those during that time. US bank holiday as well yesterday. So yeah. And it also gives you the actual forecasted and previous values. So once the actual value is out, you are able to compare at one glance. So I normally just prefer to look at the orange and red icons, or maybe any bank holidays for reference. And you can see it's a lot more streamlined and it's easier to go through and keep track of the events for each week. Okay, and it also helps you to categorize whether it's a high impact event. So like we mentioned earlier, unemployment rates, non-farm payrolls, central bank announcements, or uh, yeah, I think inflation as well would typically be considered a high impact event. So yeah, you can look at this for reference as well. Okay, are there any questions? Okay, if not, that's all I have for you guys for today. Thank you guys so much for joining me. I hope you guys found this session helpful. Have a great rest of your week, and I will see you guys again next week. Thanks, everyone. Bye. Thanks, everyone.